Hello. Okay. We are ready to go. Yeah. So today we're going to be going through the recession indicators again, and we're going to look at it from the consumer, business, and overall financial perspective. So I haven't done one of the recession indicator updates since March, I believe. And yeah, we just want to have a look at what's happened since then, because quite a lot has happened in the market since March. So as of 31st of May, looking at the housing permits, we're still seeing considerable expansion in job sentiment, retail sales, new manufacturing orders, profit margins, truck shipping, and the yield curve. Now, today we're going to go through all of these things and we're going to see what is slowing down, what is speeding up, and what exactly we need to be aware of regarding these several things, because I believe we are heading into the caution phase and very quickly into the recession phase. But first, we have to look at the market holistically and confirm if that is indeed happening. And so for June, the 31st of June, um, July, August, I think we'll begin to see a lot of these green arrows become yellow, because now we're in the caution stage. But yeah, without further ado, let's have a look at it. So let's have a look at the housing permits. So what we can see is that since, of course, March, April 2020, there's been considerable increase. So once we realized that, okay, we understood COVID, we had the first set of lockdowns. Since then, the number of housing permits exploded, and this was mostly because people were locked down. People can work from home now, that the infrastructure, technological infrastructure is there to work from home. More people began looking for bigger places, and therefore there was definitely an increased demand for home building. And we can also see how that's correlated with the rise in house prices. So when the prices of homes increase, people want to capitalize on that, so home builders build more homes. And oftentimes they have people pay for it before the home is even completed. So I think it makes sense why we've had such an increase in private home building permits. Um, and this has come coupled with the fact that people feel more secure in their jobs. So we now have record high unfilled job vacancies for the US. And if we go back to our chart, we can see that again, that we have really just an incredible amount of positive job sentiment. So people believing that no, they will not need to do so much to find another job. And it's also put the negotiating power in the hands of the employees rather than employers. And we can see that from record unfilled job vacancies and record low continuous jobless claims. So right now, people in the US, and I think in a lot of other major European countries, feel that, yeah, if I lose my job, I could very quickly find another job. And that sentiment leads to a source of complacency, where there's not much danger. Also, people, we've seen the great resignation, so we've seen people change jobs for better pay. And it makes sense. If someone, if another person, another employer is willing to pay you slightly more, you want to increase your pay, so you change jobs. This is also coupled with the fact that we have not seen a slowdown in retail sales. So retail sales again are at all-time highs as of March. So we're not going to see a slowdown in retail sales. And then it's important to also look at the inventory to retails ratio, because that is beginning to creep up slightly. So during Corona, you saw there was a significant increase in inventories to to retail sales, and this is because people were uncertain, so they did not spend on unnecessary things. They only spent on the basic things that they needed. People are working from home, people are saving more money, people have a little bit more disposable income. Immediately we see a massive increase in sales, and there was a slight hiccup in June 2020, but again, people felt more secure, we could work from home, further increase in sales. So throughout 2021, I think we had record low levels of inventory, which is the reason why there was such a high increase in inflated prices, because when you have record low inventory, you want to slow down that demand, so you raise your prices because clearly there's a demand for these goods. But then by raising your prices, it didn't have that much of an effect on demand. And then we begin to get this established inflation. But what we begin to see is that slowly inventories are piling up, and they're not making as many sales as they did before, because now that many people have bought that item, they no longer need to purchase that item again. However, orders have been made based on the previous demand. So if a lot of people wanted, for example, a new barbecue, record inventories for record low inventories for barbecues, because everyone went out and bought a barbecue. However, now that you've purchased your barbecue, you're not going to purchase a new one. So although orders for new barbecues from the suppliers to the retail store have been made, people no longer need those barbecues. Hence, inventory grows, sales decrease, and we see a large spike in this inventory to sell ratio. But the funny thing is that consumer sentiment is at significant lows. So if we compare this to 2011, so we're looking at the Euro crisis, 2008, we're looking at the Great Financial Crisis, all the way back to the end of the 70s, where we saw again record high inflation. I believe we could hit these 70s levels again for consumer sentiment. So really hit perhaps even 50, in my opinion, for consumer sentiment. And this is coupled with the fact that not only are we beginning to see a rise in retail inventories, but we're also seeing that wage growth has slowed down. So wage growth is often oscillating. So we can see that the pendulum from negotiating power for employers, where there's high unemployment, people want to keep their jobs, so they're willing to accept less pay, is swinging wildly. So usually when there's good economic times, there's expansion, it swings to the employee's favor. There's a slowdown, it swings back to the employer. And we've seen this oscillating function. I mean, it's like a sine, cosine every few years for wage growth. However, what we've seen is a significant plunge that was very much artificial. So it's to do with some kind of black swan event. So we see a sharp decrease that happened during Corona. People realized they could work from home. People switch to different jobs. So let's say that you're no longer a retail employee because, well, the retail store was closed. Then you work in a warehouse to help with deliveries, or you become a delivery driver. So therefore you go to a different job, and then you have a high increased wage because there was high demand for people to work in warehouses and delivery drivers. So that's just an example of how the labor force shifts. And we can see that the pendulum swung wildly the other way, to the point where people were finding it difficult to find people to come back to work. And this high wage growth has remained at elevated levels. So it's come back down a little bit over 2021, but we can see it's remaining higher. And I personally believe it can continue to increase, as now the demand for wage growth is not only coupled with the fact that we have record unfilled job vacancies, but also the fact that employees can now demand a lot more because their living costs have increased. So it's important to keep an eye on this US wage growth. And this US wage growth has an effect on commodities. So if we can see that in terms of job sentiment, job claims, people have money, and not only do people have money, people have the leverage to demand higher wages, which means that we are not going to see a slowdown in commodity demand. And this commodity crisis, so it's just incredible because we are seeing the Ukraine crisis. So wheat is finding it difficult to export wheat because the Black Sea is closed. It needs to be demined first. So Russia has told Ukraine it needs to be demined before you can let any ships out. Not only does it need to be demined, the only alternative is to now transport wheat, which are in these massive silos in Ukraine, to be transported out so that the new harvest for wheat can come in. So you not only want to export the last year's harvest that is stored away, you want to now make sure that you get that out quick enough so that you can take advantage and harvest the current crops and then plant for next year, because we're still forgetting that we have to plant for the future. And with what's happening in the Donbass region, it's with the war zone, it's very hard to focus on planting new grains for the next year. That, coupled with the increase in ammonia due to the higher prices of gas, we are really seeing a commodity crisis, particularly a food crisis, unfold in front of us. But so far so good. Consumer demand hasn't slowed down. People are still going to buy. People are still going to go out to eat. So that hasn't slowed down at all yet. Personally, I think eventually we have to come to some form of stop, and whether that is at 32, whether it's at 46, who knows? But eventually, the price of food is going to become too high, and the price of commodities is going to increase too much because, for example, wheat has to now be transported by rail or by truck throughout Europe. Now, there's already a high increase in oil prices, and yet you still have to transport over a long distance because Ukraine from other ports in Europe is significantly far. And then not only do you have to transport to a further port, you now have to transport to that ship to then take it to that emerging market country, which depends on Russian-Ukraine exports. So what we are seeing is unfold is a catastrophe in real time. It's a bit dramatic to say it in such a way, but that's exactly what we are experiencing. So now let's have a look at new orders. So we've seen that new orders have peaked, and this kind of coincides with industrial production. So industrial production, I believe, is peaking. So this is still data from April. So I'm curious to see what the next data from industrial production will be, because then that means that we have clearly seen a peak in new orders. So manufacturing is saying no more because we believe that there's going to be a slowdown in demand. So manufacturing is producing less, people are ordering less, and this is where we will begin to see a high increase in inventory, because the higher the inventory, the less orders that are made, the more that the effects of inflation are now beginning to be felt at the further back end of the supply chain. Then we have corporate profits. So we've begun to see a peak in corporate profits. And this is why I believe that as it stands, the current situation we are in for recession indication is caution. So back again, commodities has not peaked. So, but it's at incredibly high prices where we can begin to see demand destruction. New orders are peaking, so this should actually be yellow, not green. Profit margins are peaking, so this again should be yellow, not green, because there's not an expansive profit margin. And the next one is trucking shipments. So if I go back again, this is indicator called truck tonnage. That did take a dip, but again, it hasn't hit a turning point. So I think when we begin to see a turning point in this truck tonnage, which I think is a lagging indicator, not a leading indicator, because when there's a slowdown in orders, therefore there's a slowdown in how much is transported by truck. But we've seen since March, since 2009, there's been a steady increase in trucking tonnage. Now, there's really a slowdown in economic growth when this breaks below the moving averages of, I think, 21 and 55 moving averages. Because you can see here in 2008, there was a significant slowdown in trucking tonnage, and that is almost a confirming indicator. So it confirms that, yes, indeed, suppliers have ordered less is being transported. You begin to see that there's less need for truck drivers. People begin to get laid off because it's just a slowdown in work. And that's when we really need to begin to worry. So as of now, when it comes to the trucking tonnage, I don't believe we need to worry yet, because it hasn't confirmed the suspicions of the leading indicators such as new orders from manufacturers and industrial production. And what we can see here is that this really coincides with the S&P. So if I add the S&P indicator, yep. What's the best way to show this? 2009. Yep, because I want to show that this coincides. Let me remove this. This coincides with an increase. So when there's a significant increase in, and we've seen a steady increase in trucking tonnage, we've also seen a steady increase in the S&P. And once that stopped, then we begin to see a slowdown. But I personally believe that until a reduction in trucking tonnage confirmed, we're still in a secular bull market for the S&P. Yep, and going back to our next. So credit yield spreads. As it stands, the credit yield spread is at 2.2. So if I bring up my Twitter here, as of June 2010, we're still in a moderate stage. So we haven't hit peak credit stress. Now, given the fact that in Corona, it was 3.6, we still have quite a bit to go before credit spreads have confirmed that, yes, indeed, we are in a recession. But it's not just okay to just look at the current spreads. Let's take a deeper look at what creates credit spread. So if you go back to our previous that I had in the last one, so when we're looking at a widening credit spread, going to see a decrease in the yield for a treasury bond and an increase in yield for corporate bonds. So let's take a look at how the corporate bonds are doing. Go to bonds. And when looking at the high junk yield bonds, we have crossed significant levels. So we've now crossed the levels for 2016, but we still have a ways before we get to the same level as 2020. But we've closed the week below this level. So last week, this is where the junk bond ETF closed. So we know that the selling of a bond means that there's an increase in corporate bond yield. And I personally believe that we will continue to see a greater sell-off, because the last time we closed below this line was in COVID. And before that, we got to any levels near the levels that we are at now was 2008. Now, COVID, you can see the rapid sell-off, but then here it hit 8.83, and that's because immediately the Fed stepped in, QE infinity. So again, what supports this bond market is the corporate bond market is investor sentiment. Are they willing to lend money to corporations? Because that means that you have to believe that these corporations have the capacity to pay it back. And if we're seeing rise in inventory levels, slow down in demand, these companies may not be able to pay it back in the future. So this is why I always believe that the stock market follows the bond market. Because since 2009, these dips that we've seen in corporate bonds coincides with significant dips that we've seen in the stock market. And that usually is confirmed because fixed income traders and investors know that, hey, if people are unable to pay this money back, we are losing our money lending. So the security changes, and then once that happens, and the spread between the corporate bond yield and the treasury bond yield increases. So with the treasury bond yield, you're looking at, does this country have the capacity to pay back? And what we're beginning to see is that we are now hitting similar levels for emerging market sovereign bond debt. So this is the bond debts of, for example, the likes of Sri Lanka, the likes of Egypt, etc., Indonesia, because they need to be able to pay back these bonds. So here is a snapshot of what investors think whether emerging markets will be able to pay back their loans. And we haven't seen this. We've actually crossed the level of COVID. So that shows you, with all the lockdowns globally, investors still felt like emerging markets would be able to pay back their debts, especially when all central banks around the world began quantitative easing. However, 2 years later, investors no longer think that, especially now that quantitative easing has been done, record debt levels for emerging market countries, and coupled with the fact that there's rise in inflation and a stronger dollar. So purchasing these commodities becomes far more expensive than ever before. So right now we've closed this week below this COVID level, which is a really key level for emerging markets, because the next major level is 2009, and we remember what that was like. So right now, emerging market depth is in a bit of a free fall, and I don't know what is going to stop this free fall, because printing more money and more quantitative easing is not the way to go. The dollar is rising because we have a food crisis. So, I mean, the Dixie is at crazy levels at the moment. And the next level is what we had in 2002. So we've, we've broken our 2009 level. And I think if we continue to see a rise in strength of the US dollar, we will continue to see the inability for emerging markets to pay their debts and more civil unrest in these markets. But that's something that we need to keep an eye on. Another thing to keep an eye on is mortgage-backed security. So this is now, again, the trust in whether people will be able to pay back their mortgages. And remember The Big Short, remember mortgage-backed securities. This is the current state of the mortgage-backed security for the iShares ETF. This was the COVID level. But we know that the Fed stepped in to buy mortgage-backed securities. This is the 2008 level. We are below 2008. So that means that in fixed income, in mortgage-backed securities, there is less ability for people, there's less trust that people will be able to pay back their loans, their mortgages in the future, which is why we'll begin to see a sell-off. Not only that, the Federal Reserve, which bought mortgage-backed securities in 2020 as a result of supporting the market during the pandemic, are now going to begin quantitative easing by selling these mortgage-backed securities off, and no one is willing to step in and buy these mortgage-backed securities. So we're now running into a liquidity problem. Who is going to step in and buy these mortgage-backed securities? Because we're seeing the same thing for iShares, we're seeing the same trend for the Vanguard mortgage-backed securities, all well below 2008 levels, and no one is talking about it. And this is scary. And it's not only for homes, we're also looking at commercial mortgage-backed securities. So these are, you can imagine, warehouses, stores. I mean, even the likes of Amazon is reducing their warehouses size and renting it out to others. Because even Amazon is like, well, we don't need all these warehouses anymore because, well, the retail sales are slowing down. So private homes, households, no one believes they'll be able to pay back their mortgages that they've taken out, especially the really high mortgages that have been taken out since Corona. There's a belief that brick and mortar stores are going to close up shop. And this is all reflected in fixed income sentiment, which is why I find it phenomenal that not enough people follow the fixed income market, because it literally tells you where the biggest investors, the largest institutions are investing their money. And we can even see with the 7-10-year Treasury bond ETF breaking a solid trend line, upward trend channel. And right now, again, it's in free fall, it's cutting through these key levels, these key monthly levels. And I'm curious to see how long will it be before the Federal Reserve begins to switch from too much hawkish sentiment to dovish. Because eventually they have to scream uncle when there's no one willing to step into the market and save the market. So it's beginning to get scary out there. This is this doesn't say much, to be quite honest. These are all of the aggregated bonds from the Lexio ETF. I mean, this is just incredible. I'm curious to see how far it will go down before even I start to buy these bond ETFs, because the yields are record high. Now, let's start having a look at some of the long-term bond yields. So I think the last on our recession indicator was yield curve. Yes, so I made a good choice going to bonds. So right now, the yield curve still looks like it's showing expansion. So we know that before the yield curve inverts, it's expansion. So all the way down, this is expansion. Then we hit a peak, and then we have what's in the green, recession. As it stands, we are still showing expansion on the yield curve. So between here, so between March, April 2015, we are showing expansion until we invert it. So we've inverted before, but I think we could have a double dip inversion of the 10 2-year yield curve. Double dip. So come back down again until the yield curve, the yields for treasuries become so attractive that investors start to put their money in there. So at what point does the sell-off for the 7 to 10 year bond for the US Treasury bonds become so attractive, even for emerging market bonds? At some point, investors are going to see a better prospect of return. So would you rather have 10% in an emerging market bond yield, and you know that you're going to get 10%, than to take a risk with every year, than to take a risk with the stock market? Because again, this is all a relationship between risk assets and less risky assets. Every asset has a risk. It's just which one is showing the best value for risk. And right now, we begin to see that bonds are making a comeback, because companies need liquidity. They need to borrow from investors. And we can see this with the 30 yield, 30-year yield is broken out of what I would say is a secular trend for bonds. So it's broken out of this channel, and you can see it's very similar to the channel for the 30-year mortgage. So now people are going to start saving more rather than take the risk with the stock market, because, well, bonds are offering better returns, better percentages than ever before. So it's a question of just how far can these bond yields increase until investors start to say, you know what, it's not even worth it, put it in the market anymore, just put it in bonds. That's a scary place to be, because then the value of these companies drastically take a hit. And it's not only the US, other major G7 countries are experiencing this, with the same breakout that's happening with the UK guilds. We're again seeing a massive breakout in channel to the upside. France with the 10-year as well, another breakout. Now, what I find is incredibly scary is what is occurring in the German market. So German bonds and the Italian bonds are now beginning to have a certain spread. So the reason why this is quite a good indicator is because you put your money into a German bond, you put your money into an Italian bond, it's still euros. So if it gets to the point that there's such a spread between different countries in the euro, and this is where the euro crisis occurred, where there was such a spread in bond yields from Greece to Germany, from Italy to Germany, that we're beginning to see again, that we haven't seen since COVID, since September 2018, since the euro crisis of 2011, 2013. So what we are beginning again to see is another euro crisis. So it's not only a food crisis, an energy crisis, it's a euro crisis. Because the moment those spreads begin to widen, why would I put my euros into a German bond when I could get a better yield in an Italian bond, and I still know it's part of the EU, or into a Greek bond, and I still know it's a part of the EU? And once investors begin to look at these spreads, they begin to put their money into the Italian bond rather than the German. But then the Germans need support as well, so then their yields increases, and we begin to have this cycle. And I believe that with the current euro crisis, we are set to see higher German Italian bond yield spreads, and it really starts to become scary when we start to hit 5% plus on these spreads. That's when we really have to worry. But by then, it will be already be in the news. So, hey, when we look at the Greeks, the spread between the Greek and the German, we see there's a triangle breakout. So I think we can see again a very explosive increase in the spread between the Greek and German bond yield. If again, once we cross levels such as 11%, 12%, and we see an explosion upward towards 30%, it's time to get worried, because then we again have Euro crisis 2.0. Yeah. So just, we're seeing the same thing, the same pattern with America, with Canada, with Australia. I believe we can begin to see this for a long period of time. So, the next we need to look at is an update in the crypto market. So, crypto has been having a lot of fun, and it's nice to have a 24-hour market. So, right now, it's still going. We've seen that it's hit the 166 level. So, I already have this box here, and I published a message about it on Twitter. It's hit that level just like I expected and bounced again. Right now, Ethereum is down. Wow, what is it now? Oh, minus 71% from all-time highs. Not shabby at all. The last time that's happened, if we have a look at how far did it go down before it hit the bottom, from 2008. Okay, minus 94%. So crypto can still go a lot further down. And personally, I believe crypto is a liquidity indicator. So we're seeing liquidity being sucked out of the market. God knows what could happen, but it doesn't look too good for Ethereum holders at the moment. And I believe the same is for Bitcoin holders as well, really breaking down past the key level here. If we look at what's happening on the weekly, because I like to trade the weekly. I think once you start getting towards the daily or the hourly, things become muddled up with the algo. So when you're on the weekly, you have a clearer view of what the market is doing. But this is a great buy the dip level for crypto. Now I can imagine you can buy a little bit here, at this 166 level, or if it breaks, you know, buy the dip at a slightly lower level here, because by then I think, how far down would we be? We would be from all-time highs. Okay, minus 70 for Bitcoin, which Bitcoin being the strongest crypto, yeah, it's hard to see, but who knows? We could go down there to that level. We can go down even further. It's always nice to look at it on a log chart. So if we check out, I think Bitcoin to USDT. Yep. So this was my first buy the dip zone, and my second buy the dip zone. Yeah, personally, I think we can go down quite a lot with Bitcoin. And again, if we see another intervention from the Fed or more dovish sentiment, we can see an explosion with crypto, because that means that there's more liquidity remaining in the market. So for me, I tend to look at crypto like a liquidity indicator. Also, it's very retail driven. So if retail has more money, they're willing to spend it. When retail has less money, they're less likely to take a gamble, because that's effectively what it is. It's a bit of a gamble, and we can see that once there was a sharp liquidity shock during Corona, we saw crypto. We saw crypto go down 60%. Yeah, 61%. 61, 62%. So that was just liquidity crisis. So I personally believe that if we see another liquidity crisis again, another liquidity shock, which slowly was seen as liquidity shock, so it wasn't as sharp of a drop off as we saw with Corona, but this is why I think we can go into our buy zone 2. But in comparison to previous years, we have more institutional buyers. There's more institutional interest in crypto. So who knows? But I think now we're hitting really nice levels for crypto. Levels that even I would be like, oh, okay, if you want to buy at that level, sure. But still keep taking into account the macro sentiment. So yeah, for me, that's about it. Even the Binance coin, which I've always found quite interesting, doesn't look too appealing at the moment. This is the altcoin index that I remember. That's definitely in a strong decline. So I don't think now is the time to go play risky games and buy unknown coins. Now, I've always had a look at the altcoin Bitcoin cycle. So whenever and this is almost spot on, that I think it's been a while since I created this chart, and I've just kind of ignored it. Didn't think of it as anything, but I've always noticed that there's between the Bitcoin dominance. So everything is ruled by Bitcoin in crypto world. And the time to buy altcoins, I've always placed it here. So historically, this has been the time to buy altcoins. You see altcoins pump, and then we've seen decline. So I modeled this based on what happened in 2018. And this was really the time to sell altcoins, because relative to the Bitcoin dominance, I felt, yeah, this doesn't make much sense. So again, this was the time to buy altcoins. This was the time to buy altcoins. And sure as anything, it again hit this level, hit this trend channel, and bam, to the upside again. So now we're beginning to see that now, if you haven't sold your altcoins already, probably a good time to sell them, because chances are we're going to wait until we hit this level here. So if I extend this trend channel line, I think the next time to buy altcoins is around here. So yeah, depending on how fast the altcoin move is, just keep an eye out for, could be in 2023, could be late 2022, can become the time to buy altcoins. So whether it's time to buy Bitcoin and just hodl, sure. I think Ethereum is around Bitcoin's level at the moment. So there's a lot of strength in Ethereum, probably more than ever before. But now we are hitting the 2017 peak. From 2017, we've seen, yeah, we went down 94. So based on just what happened after 2017, 2018, we should be prepared for a dip of such a level. I think preparing for a 94 dip, 92, 90, yeah, it's valid. It's valid to prepare yourself for such a dip, unless you're really like, you know what, I'm a hodler for the next God knows how many years. I'm not. I'm very much a guy that is in the mood, because I mean, this has been since 2018. I remember when I first got into crypto, 2018, got burnt all the way down, and 90+% is a big back to hold. So for anyone who's doing that, we're crossing a pivotal level here. Keep an eye out for general liquidity in the market, because I think we're heading into a very nasty liquidity crisis that's mixed with a commodities crisis. But keep an eye out for certain levels to buy the dip. I still feel like it's quite high to buy the dip here. Especially considering that Ethereum is an altcoin, Bitcoin, also for Bitcoin, in my opinion, it's important to keep an eye out for these levels of liquidity, and it's important to see, okay, why did it stop? So why in December 2018, why was that the end of the route? Personally, I believe it's because there was another step in from the Federal Reserve, a slowdown, a more hawkish sentiment, more dovish sentiment. So yeah, that's kind of it from me. I've spoken for about 50 minutes now, so I've spoken for a long time. But yeah, just keep an eye out for that. In crypto, this is the current state of the DAX 40. Nasdaq again, really at a pivotal level. So next week, I'm interested in what's going to happen next week. I'm really interested in what's going to happen next week. I think a lot of people are not fully aware of just how illiquid the market is at the moment, and how very few buyers are willing to step in and buy but there are a lot of sellers who are willing to sell if economic data and winds change suddenly. So keep an eye out, and yeah, good luck.